Most people hear private equity and think of billionaires, boardrooms, and backroom deals. But how does it actually work? What's really going on when a private equity firm takes over a company? Let's break it down in real human terms, not Wall Street jargon. Private equity firms are like corporate surgeons. They buy companies, cut the fat, fix what's broken, and then sell them for a profit. But here's the twist. They usually don't use their own money. They raise money from wealthy investors, pension funds, even university endowments. Think Harvard, CalPERS, or even the Ontario Teachers' Pension Fund. That's right. Your retirement money might be funding billion-dollar deals without you even knowing. Now, once they raise a big pool of capital, they go shopping. Let's say they spot a struggling retail chain. It has solid products, but bloated costs, poor management, and way too much debt. The pay firm swoops in, buys the company using a mix of investor cash and borrowed money. This is called a leveraged buyout. In some cases, over 70% of the deal is debt. That's like buying a house with a tiny down payment and a massive mortgage. Then the real work starts. The firm installs new leadership, slashes costs, renegotiates contracts, closes underperforming stores, maybe sells off part of the business. Suddenly, the same company is leaner, faster, more profitable. And when the turnaround is complete, they either sell it to another buyer or take it public through an IPO. Boom, the firm cashes out. The investors make returns. Everyone celebrates. Or do they? Here's the darker side. Workers often get laid off. Some companies are saddled with so much debt they can't breathe. Look at what happened to Toys R Us. In 2005, it was taken private in a $6.6 billion deal. But the debt load crushed it. In 2017, it filed for bankruptcy. 30,000 workers lost their jobs, all while the private equity owners had already pocketed millions in fees. This isn't rare. Research shows that companies acquired by PE firms are 10 times more likely to go bankrupt within 10 years than similar companies that aren't. But it's not all doom. Some PE firms have successfully turned around hospitals, green energy startups, even tech firms. In 2024, a PE firm revitalized a struggling solar panel manufacturer in California, doubling jobs and output in less than a year. So the impact can swing both ways. At its core, private equity is about risk and reward. High leverage, high pressure, high payoff. For some, it's a financial miracle. For others, it's a corporate wrecking ball. The truth? It depends on who's holding the scalpel.